Traders, welcome back to another video. It's been a while since I posted new video on the channel, but now I am back. Pin bars is one of the most widely recognized and used candlestick patterns when trading price action. However, many traders trade it the wrong way. In this video, you are going to learn how you should correctly trade pin bars and how to identify which pin bars you should be trading and which ones you should avoid. But before I dive deeper, if you are new on the channel, please subscribe to the channel, hit the like button and also hit the notification bell. What exactly are pin bars? Pin bars are candlestick patterns that have a small body at the end of the candlestick with a relatively long wick. Candlesticks that have bodies half the length of the candlestick as pin bars as well. As long as the full body is located above or below the halfway mark, it can be considered a pin bar. And if you noticed, they can have either bullish or bearish bodies. For pin bars, the color of the body doesn't determine if it is bullish or bearish. Instead, the body location determines that. So if the body is located above the halfway mark, it's considered a bullish pin bar. And if the body is located below the halfway mark, it's considered a bearish pin bar. Some traders call the pin bar as hammer candlestick, but the name is not important. What's the most important is you understand what the pin bar signifies. The pin bar signifies a potential reversal in the market. Where many traders get it wrong is that they think every pin bar is considered a reversal. And so they trade every single pin bar and they start losing a lot of money. How not to trade pin bars. So which pin bars should you avoid trading? There are two types of pin bars you should avoid trading. Pin bars that appear against the trend or without any reversal chart pattern. Long pin bars. Here is an example of a pin bars that appear against the trend or without any reversal chart pattern. In this chart, I've also added two exponential moving averages, the 20 exponential moving averages and 50 exponential moving averages. You can see that the market has just transitioned from an uptrend to a downtrend. The 20 exponential moving average crossed below the 50 exponential moving average, with the market starting to make lower lows and lower highs as it moves below the 20 exponential moving average. This means the market is now considered to be in a strong downtrend. When the market is in a very strong downtrend, you must be very careful about going long. No matter what bullish candlestick patterns you see, if the downtrend momentum is strong, the market most of the time will just run through it. As you can see on this chart, there is a bullish pin bar formed. Many beginner traders will see this and go long after the bullish pin bar is formed. Their thinking is that since the market has gone down quite a bit, it's time for the market to go back up. This is so wrong. A market that has already gone down a lot can continue to go down further, and likewise, a market that has already gone up a lot can continue to go up further. You must never get into a trade simply because of a single candlestick pattern, especially when you're taking a trade that is against the trend. As you can see in the chart, the next bar went below the bullish pin bar, and if you were in that trade, you could get stopped out very quickly. This is the wrong way to trade pin bars, and you must never trade this way. Second, the other pin bar to avoid trading is a long pin bar like this. You can see in the chart above that the bearish pin bar is much longer than the other candlesticks. This is usually caused by some news releases, and it increases the trading volume in a certain period of time. The reason we don't want to trade such long pin bars is that it can be hard to get a good risk-to-reward ratio. Normally, after a piece of high-impact news is released, there will be a spike in volatility and the market can create long candlesticks like this bearish pin bar. And if you enter a trade on that bearish pin bar, your stop loss would be quite far away from your entry point. With a wide stop loss, you would require a wider take profit as well. And the problem with that is that after the news has been released for a while, the volatility will die down and normalize to its usual volatility. When that happens, it makes it harder to hit your take profit level. So, how to trade pin bars correctly? Alright. Now that you know which pin bars to avoid, let's see which pin bars you should be trading. One important thing you should keep in mind is that when trading pin bars, you do not want to trade them on their own. Pin bars are not trading setups. Pin bars are entry triggers. That means you first look for your trading setup. Only once you have a valid trade setup, then you use the pin bars as confirmation of the trade. If don't have any trading setup, don't worry. In this video we are going to teach you. Here are a few setups that are considered sensible and valid to trade the pin bars with: support and resistance levels, chart patterns, divergence. When you combine pin bars with a valid setup, it will increase your trading success. Before we get into the specific setups, you need to first know how to enter a trade with the pin bars. Pin bars entry methods. After a pin bar has been formed, there are three types of entries. Entry method number 1, at the close of the pin bar. Entry method number 2, at the break of the high or low of the pin bar. Entry method number 3, at the close above or below the pin bar. The entry method number 1, at the close of the pin bar. To enter into a trade using this entry method, you simply wait for the close of the pin bar and then enter into a trade. That means once the pin bar closes, you immediately go long or short using a market order. Here's where you go long for bullish pin bars. And here's where you go short for bearish pin bars. This is an aggressive entry since you do not wait for further confirmation that the market will go in the direction of your trade. Further confirmation is to wait for the market to either break the high or low of the pin bar, or to wait for the market to either close above or below the pin bar. The entry method number 2, at the break of the high or low of the pin bar. This entry method is to enter into a trade when the market...
Thanks for watching. Hope you guys have enjoyed the video, and please don't forget to like and subscribe to the channel. I'll see you in the next video.